Joining us now to react, Dan Clifton is head of policy research at Strategas, a Baird company, and Claudia Sahm is New Century Advisors chief economist. Welcome to you both. Claudia, let me just start with you from kind of the, I was going to say egghead, but that would be impolite. From the economics profession's point of view on all of this, but also, I mean, you've had some really thoughtful things to say about what is going on with the economy and inflation. What's your reaction to Warsh's comments?
It's important that we have a robust discussion about the Fed. They should not be above critique. I welcome Warsh's ideas and thoughts here, but when I hear the word regime change coming from someone who is one of the leading candidates for Fed chair, I get really worried because I line that up with President Trump's repeated emphasis on he wants lower interest rates, not just a little lower, like 3 percentage points lower. That's in a situation where the White House is in control of monetary policy, and we've done that in the United States. Like, we had a very different regime during World War II. The Fed set rates low so we could fund the federal government at a low cost. So it's just we're kind of touching on all these subjects, this history that, you know, we've learned the lessons of the past. The Federal Reserve's independence is important for the markets. I really don't want to learn that lesson over again. But, you know, we should have this debate.
Dan, kind of jump in here, and what were your thoughts, and what do you think we learned from Warsh's comments this morning?
Well, first, I think he's advocating where the president is coming from. I don't take positions one way or another. I just try and take what's in front of us right now. What I see in front of us is that the Trump administration is worried that the ECB funds rate is about 225 bips over the Fed funds rate. They would like to get that about probably 100 basis points lower. They're worried that Powell's going to stay on the Fed when his chairmanship ends in May because he could stay on for another 2 years and work as sort of a shadow chair against the current Fed chair once they get that slot. And so what I think we're seeing is a lot of angling to the point of where what happens when Powell leaves. The president's obviously going to have a new Fed chair, but there's an awful lot of people on the Fed right now who don't want to cut rates, and that's going to be the big challenge for the next Fed. In the meantime, the Treasury Secretary has a lot of different tools to be able to prevent the 10-year from going over 5%. They don't really need the Fed. And I think you're going to see a lot of that at the quarterly refunding announcement at the end of the month, where we anticipate that there's going to just be a higher amount of T-bill issuance and the potential for more Treasury buybacks. So a lot of this is just the wrangling to get there. And I think if Powell doesn't get off the Fed, they're going to use this construction building after his term expires as chair to be able to release him for cause. It has about $700 million of overruns. I mean, that should be the cost of the building. That's just the overrun cost. And that's less about monetary policy and more about the taxpayer side and some oversight to what the Fed is doing.